Hello, everyone, and welcome to today's Beginner's Room session with me, Sylvia Barrock. In today's session, we're going to discuss entry and exit strategies. This is one of my favorite topics because it is extremely important. It's very important to pick the right entries, to figure out where are potential exits or targets, and to build a good system that you have bigger rewards versus risk. So we're going to be discussing that today live on the chart. And before we start, I'm going to go also through my whiteboard and share with you what exactly I'm looking for and draw that a little bit because that is for the beginners. I would like to explain it in a simple way so you understand it. So normally when I trade, I really like to keep things very simple because every time you add complexity to everything, things are becoming more more difficult. So that's the main reason. And now starting with that, I'm gonna open here on my right also the chat. Starting with that, I would start with, first of all, yesterday we discussed a little bit more about cycles, sideways cycles, accumulation cycles, uptrending cycles, distribution, and downtrending cycles. So that is the number one step to identify your entries and exits. And like I discussed yesterday, there are different approaches in the different cycles or different strategies. You can't use the same strategy, the exact same strategy in all cycles. And the main reason for that is that different cycles are basically moving differently. They have different behavior, different price action. And if you're trying to apply, for example, in an accumulation phase, setups from an uptrending phase, this is probably not going to work because setups in a uptrending phase tends to break out more, not pull back so much, while in the accumulation phase, you basically have a sideways price action and you're trying to buy at the bottom and close at the top. So there are some differences. And with that, we need, of course, the different entries and exits. And especially like in a distribution phase, for example, a lot of the times it's very choppy, very turbulent markets. So in this case, you have to be able to identify that and make sure that you're exiting the positions at the right spot or quicker compared to an uptrending cycle. Okay, so again, like I discussed, I would like to start with my with my um, with my whiteboard right here. And again, guys, this is just for you to make it a little more simple and understandable what we're looking at here. So we're going to go on the charts just in a few minutes. I just want to give you a quick example. What are we looking for based on the candlesticks and draw that a little bit for you so you know what exactly are we looking for. So first of all, like I said at the beginning, very important for me is to identify the different trends. In this example, I'm looking here in an uptrend, and what we're looking at as an entry is the correction of an uptrend. So we have always an impulsive move in the trend direction, correction, followed by another impulsive move in the trend direction and correction, and so forth. What we're looking at here is a couple of candlesticks coming back to the downside, coming back down. And once we see one first green candlestick, we are entering around this zone. Now, for those of you that are new and on YouTube as well, I want to mention that this here, I strictly follow only on the daily chart. I really don't like using this strategy on the lower time frames because lower time frames tend to be a little more volatile. You have a little more market noise and everything is a little more choppier. On the daily time frame, on the other hand, you have a little more clean looking picture and the signals are less, but they're more significant. So once you get into a good trade, you should be able to catch pretty decent move out of the trade. I see here in our chat, Boyki and Cian, welcome guys to this session. Nice to see you as always. I hope everything is well on your end. And I hope you're doing well also with trading. Let me know, of course, as always, if you have any ideas or questions, we will discuss them. So what we're looking at normally is the support zone. For those of you that are new and don't know, supports are areas where the market tends to bounce off this zone. And normally this is a zone where you see the previous low on the chart, or this is a breakout zone. I'm going to pick here, for example, this one's, for example, this here was once previous high. And after the breakout, this becomes support. This is this zone right here. Now, we don't know when the market starts to correct. When is it going to stop correcting? Is it going to stop here at the first support zone, or is it going to continue further lower and stop at the previous low around this support zone? We don't know it. The market basically decides what needs to do. Our job, though, is to understand the price action and the behavior based on the candlesticks and figure out, is this the right time to start buying? The candlesticks on the daily chart, like I said, are very, very accurate in that. So I've been doing this now for 10 years, and I can tell you guys this is one of the most accurate things I've personally seen and done, because what you're doing is happening live. So you're not relying on indicators that are lagging, and you're not late. So if you learn to read the price action the right way, there is really no better way to use that, in my personal opinion, of course, on the charts. So if the market stops, like in this example here, around this zone, what we're looking at in this case is, after a couple of red candlesticks, we're looking for one first green candlestick. This first green candlestick needs to be, for example, a reversal candlestick or a bullish engulfing candlestick. Basically, something that shows us that bears are slowing down here and bulls are taking the control over. That's what we're looking at here. This can look different ways. We're going to go on the chart and I'm going to show you, multiple different charts, how that looks like. But in general, what I like seeing is, if I see a bullish engulfing, for example, that's one bigger red candlestick, like right here, this one, bigger than the previous red one. That's a sign that bulls are stepping in and starting to buy the market. Another sign that I really like and set up is when I see a reversal candlestick. A reversal candlestick has a wick on the bottom and it closes right here at the top. So that's a very, very good actually setup, because that has also meaning. And I like explaining things, guys, a little. I like understanding everything a little more in depth, rather just following patterns or relying blindly on on indicators. Have to understand that the market is based on emotions and behavior of other market participants. And so you always need to ask yourself, whenever you're using, if it's an indicator or anything else, why are you exactly using that? What is the meaning of it? Is there something that you see on this candlestick that shows you that there are more buyers stepping in? And in this case, the answer is yes, because if you have a reversal candlestick, normally you have the low of the candlestick, which is right here. And this low of the candlestick is basically the lowest price for the day. Obviously, the buyers took over control of the situation, and the candlestick closed all the way up. So this means, on the other hand, that the sellers were not able to keep pushing the price lower or sustain this price. That is the sign that I'm looking for when I'm trying to enter on the long side after a correction, that bulls are stepping in. And again, guys, this is actually very simple. You don't need complexity actually in order to make money on the markets. You need discipline and a system that is profitable. And of course, you follow the system, which is the discipline. So the next possible entry is when we have a little small candlestick with wicks on the top and bottom. This also means a little more indecisiveness is happening, and the entry is right above. Remember, all the entries are happening here above. So in this case, it's over here. In this case, it's over here. And in this case, would be here, and so forth. The stop loss is slightly below. Again, the stop loss depends on also the support zone. What I like doing when I use stop losses is I like allowing myself a little more room. So I don't really like, putting way too tight stop losses, because a lot of the times I'm going to get stopped out and the market is going to go in my direction, and I'm not going to be part of it. And this is very, very frustrating. I'm sure you have experienced this, some of you. But that's why I like to leave some room for the market to, do its thing, breathe, like I like calling it. And then when it's my time to, to get something out of it, it will happen. I just don't like to put the stop losses too tight. So in general, stop losses needs to be below the candlestick with a little room, like I said. Or if that's the support zone, that's even better. That's below the support zone. Now, the last type of an entry is the bulls take over entry. In this case, you have same thing, a bunch of red candlesticks like what we see here on the daily time frame. And then all of a sudden, you have one green candlestick that closes above the midpoint of the red candlestick. That's our sign that they are more buyers stepping in. Now, before we continue with the charts, guys, I want to tell you that it is extremely important here to look at the distances from your entry versus your potential exit, or so to say, take profit. Normally, you should have at least 1 to 2 risk versus reward. And the reason for that is because over 100 trades, even if you're half of the time wrong, this is very important, guys. Even if you're half of the time wrong, which is, kind of something where most traders start with, you will still be able to make money because your winners are bigger than your losses. That's why it's extremely important to look for at least 1 to 2 risk versus reward, because over 100, 200 trades, you're going to be on the winning side. So very, very important. Now, if you guys have any questions regarding to this, feel free, of course, to let me know at any time. So what I mean with that is if you enter here as an example, and this is your stop loss, and you need to make sure that this is your resistance, which is the previous high, and your target, that you have at least 2 times on your risk, at least 2 times the distance. So the distance from your entry to stop loss needs to be 2 times the same distance up to your target. Very important, because this is the only way how you can make sure that that you are gonna get a big trade. That's why the reason for that is that's why buying at the bottom around correction is a very, very good idea, because you know, you basically have a very good risk versus reward, versus if you're buying at the top, you're just putting yourself immediately in a bad spot and situation, because if you're buying all the way up here and you have the stop loss over here, chances are that the market is going to pull back, go sideways before it actually breaks out. So that's why it's extremely important to look for good entries with good risk versus reward. Now, I want to go ahead now, guys, and start with a couple of examples here and explain to you what we started discussing. So basically, start talking about the different cycles, how to read them, and how to enter on and trade them. Because right now, what we see on the markets, we are in a distribution cycle on the S&P 500, US 100. So all these indices are, starting to pull back a little bit. They've been bullish the whole entire year, and now we start to see a little bit more of a pullback and bearishness. And in my opinion, this is the most challenging market to trade, because in an uptrending market, it's kind of easy to take, profits and just buy the dip and hold it. That's kind of one of the easiest